What if the fastest way to pay off your mortgage wasn't to invest less, but to invest more? There's a strategy that does exactly that. It's called debt recycling. By the end of this video, you'll understand exactly how it works. You'll see it run with one simple example. You'll know the loan setup that keeps it legal, whether you're actually the right person for it, and the one small mistake that can quietly cancel the whole tax benefit. This isn't a loophole. It isn't get rich by borrowing more, and it isn't American advice with the dollar sign swapped out. Debt recycling is a strategy the ATO already recognizes, and it doesn't ask you to take on a cent more debt than you were going to invest anyway. It just changes what your existing debt is doing. Here is the one idea the whole thing sits on. In Australia, interest on the loan for the home you live in is not tax deductible, but interest on money you borrow to invest, to buy something that earns income, generally is. Same dollar of debt, completely different treatment at tax time. That gap is the entire engine. So here is how the next 10 minutes go. First, what debt recycling actually is. Then, one clean example with real numbers. Then, the money trail rule that keeps it legal. And it's the part most people doing this themselves get wrong. Then, who this is genuinely for, and who should leave it alone. And finally, the risks, and how the whole thing ends. That third part, the money trail, is the one I'd least want you to miss. Most people think debt recycling means borrowing more money. It's almost the opposite. You're taking debt you already have and giving it a new job. Right now, your home loan is a one-way street. Money leaves your account as interest and nothing comes back. Debt recycling turns it into a two-way street where that same debt starts working for you. It runs in a loop. You take some savings and instead of just parking them, you use them to pay a lump off your home loan. Then, you split that same amount back out into a separate loan account and you draw it straight out to buy investments. Because that borrowed money is now being used to invest, the interest on it becomes deductible. Then you take the income from those investments, plus the tax you get back, plus your usual spare cash, and you throw all of it at the part of your home loan that isn't deductible. As that part shrinks, you split out a little more, invest again, and repeat. Every loop turns another slice of deadweight debt into debt that's actually working. Numbers make this click faster than any explanation, so let's walk one through. It's an illustration, not a promise, but the shape of it is real. Say, you've got a home loan of $600,000 at about 6%, and you've managed to save $50,000 on the side. Let's also say you earn around $150,000, which puts you on the 39% marginal rate once you include the Medicare levy. You take that $50,000 and pay it off your loan. Then you re-borrow the same $50,000 into a separate split and you use it to buy income-producing ETFs. Now the interest on that $50,000, around $3,000 a year at 6%, is deductible. On a 39% rate, that's about $1,170 back at tax time. The ETFs pay you dividends too. At around 4%, that's roughly $2,000 a year. And here is something an investor borrowing to buy shares overseas simply doesn't get. In Australia, those dividends usually come with franking credits attached, which means some of the company's tax has already been paid on your behalf. A 4% dividend can end up behaving more like 5.5%. There's a second quiet advantage. Most of an ETF's long-run return isn't the dividend, it's the growth in the price. And you don't pay tax on that growth until you actually sell, so it compounds in the background, untaxed, for years. So each year you take that tax refund, plus the dividends, plus your normal spare cash, and you point all of it at the non-deductible part of your loan. It shrinks faster, you re-borrow what you've paid down, buy a little more, and go again. Two things now happen at the same time. Your bad debt falls years ahead of schedule, and an investment portfolio quietly grows right next to it. Run that loop for a decade and you can come out the other side having knocked years off your mortgage and build a six-figure portfolio from the same pile of debt you already had. But it only comes out ahead if your investment return plus that tax saving beats what the debt is costing you after tax. And only if you can hold your nerve when markets fall. This next part is the one I'd protect above all the others, because it's where the do-it-yourself version quietly falls apart. Remember the small mistake I said could cancel the whole tax benefit? Here it is. The ATO doesn't really care which account your money is sitting in. It cares what the borrowed money was used for. That's called the purpose test. To claim the interest, the borrowed dollar has to travel in a clean straight line from the loan account to the investment and touch nothing else on the way. The moment you let that borrowed money mix with your everyday cash, even for a day, even by a single dollar, you contaminate it. Now, part of that loan was for investing and part of it was for something else. And your accountant can't cleanly claim the interest anymore. So hold two things separate in your head. The loan split is the borrowed money, and its only job, ever, is to buy investments. Your offset account is your own money, and that's where the dividends and the spare cash go to attack the home loan. Borrowed money out to invest, your own money in to pay down. One direction each. This is also why redraw is the wrong tool for the job. A redraw is really the bank's account, and money moving in and out of it muddies the purpose trail. A proper, separate loan split keeps it clean. And not every lender sets these up well, which is exactly why this is one to arrange with a broker, not on a banking app at midnight. Here is where I'd rather be honest than exciting, because this strategy is genuinely the wrong fit for a lot of people. It tends to make sense if you've got a stable income you can count on, an emergency buffer already sitting there untouched, a long runway of 7 to 10 years or more, and a marginal tax rate high enough that the deduction is worth something. The higher your rate, the harder this works, which is why it shines most for people on 37% and up. And it's the wrong move if your income is shaky, if you don't have that buffer yet, if you'd need the money back in a few years, or if a market drop would keep you awake and push you to sell at the worst possible time. There's a fair objection here, and it deserves an answer. Those dividends you earn are taxable. They get added to your income. That's true. But two things soften it. The franking credits we talked about come off the tax on those dividends, and the interest you're deducting pulls in the opposite direction, bringing your taxable income back down. This strategy was never really about the dividend anyway. It leans on the whole return, growth included, over a long stretch of time. Every strategy has a bill attached, so let's put this one's on the table. The first cost is the obvious one. You're investing with borrowed money, and borrowed money magnifies both directions. If your investments fall, the debt doesn't fall with them. You still owe every cent. The second is timing. If the market has a rough few years right when you're starting out, it can feel like the whole thing is working against you. This is a long game, or it's nothing. The third is interest rates. If they climb, the cost of holding that investment debt climbs too. You want room in your budget, not a plan that only works at today's rate. And the fourth is the one people forget. Tax law can change. The deductibility of investment interest is a rule, and rules can be rewritten. That's not a reason to avoid this. It's a reason not to bet your entire future on a setting the government controls. So how does it end? As those investments and your income slowly pay the home loan side down to zero, your non-deductible debt just disappears, years earlier than it would have. What you're left with is a portfolio and a loan that's now fully deductible. From there, you can keep it ticking or start winding it down, ideally selling investments in a lower income year or in retirement when the tax on any gain is gentler. You're not locked in forever. You're building a door out from the start. So, quickly, your home loan is a one-way street, and debt recycling turns it into a two-way one. You split, you invest, you send the income and the tax back to kill the bad debt, and you repeat. You keep the borrowed money's trail perfectly clean. You only start once your buffer and your income can carry it, and you go in knowing the risks and knowing where the exit is. Here are your tonight actions. And I'll be straight with you. This is one of the few strategies you genuinely shouldn't finish on your own. So tonight is about getting ready, not pressing go. 1. Open your banking app and find out whether your lender actually lets you split your loan into separate accounts, not just redraw. Write down your loan type and your current rate. 2. Go to paycalculator.com.au and find your real marginal tax rate. That single number decides how much a deduction is worth to you and whether this is even worth the effort. 3. Check that your emergency buffer is already sitting somewhere safe and separate. Debt recycling comes after that's in place, never before it. 4. If those three line up, book a short conversation with a mortgage broker to structure the split. And tell your accountant you're considering debt recycling so they can keep the trail clean from day one. This is a strategy you build with two professionals, not one you improvise alone. One last thing. Debt recycling is really just borrowing money to buy ETFs, which means the biggest decision here was never the loan. It's which ETF you actually buy with it. Get that wrong, and you've taken on debt and risk for a lower, shakier return than the one you were trying to beat. I've got a full video on exactly what to check before you put $1 into an ETF. That video is right here, and I'll see you over there.